Welcome everybody to the Catalyst Funding February Real Estate Market Update. We're so excited to have you back for what we've heard at one of our latest events is something that everybody really appreciates, us bringing the knowledge as far as the real estate market, the current investment trends, and all of that data every time we have a special guest. But first, before I introduce our special guest today, I want to introduce the founder and CEO of Catalyst Funding. That's Wade Comeaux.
Hey, everybody.
And also we have the Director of Lending with us today, Jeff Johnson.
Howdy.
And then I'm your Marketing Director, Derek Engler with Catalyst Funding. And we are pleased today to have Jeff Smith with Lifestyles Realty, Inc. And Wade, I'll let you introduce our special guest.
Yeah, Jeff has been a regular guest with us, and we get great feedback. I've known Jeff since we became a sponsor of Lifestyles Unlimited, I guess back in 2014. And he just brings an incredible wealth of knowledge, experience from him doing the deals himself. And we're just big believers in Lifestyles Realty in general. They've helped so many people become financially free and change their financial future, create generational wealth. We see people that they've helped that come in with very limited funds overall, and over like sometimes a very short period, they can become very independently wealthy. And then if they take 10 years, and they'll be maybe come in with under $100,000, and they are major owners of multifamily doors that might total into the hundreds of thousands. So it's kind of an incredible story that he and his company help people navigate through. So with all those words said, I'll turn it over to Jeff for a moment to talk a little bit about what he has going on in his own personal investments, and then what's going on at Lifestyles Realty as well.
Oh, great. Thank you, Wade. Now, I do need to make one correction. I don't believe I know anybody with hundreds of thousands of multifamily units, but I do know several with tens of thousands of multifamily units. So it's if I led you to believe hundreds of thousands, that was an exaggeration. I may have just.
I mean hundreds or thousands. It should have been or. My bad.
Right. We just got excited, Jeff. That's all.
Yeah.
Well, I do too, and so maybe I said something, in a bragging way that wasn't exactly right. Anyway, thank you. Like you said, my name is Jeff Smith. I've been a member of Lifestyles Unlimited for a long time. I started investing, and you said starting with little. I started investing with very, very little. I had a great credit score, but I didn't have very much money to my name at all. And I was fortunate that I married into a real estate investing family. My wife's parents were real estate investors, and they sort of guided me along. They helped us along in terms of lots of information, lots of help. And but one thing they did mention was, look, we're not going to get anywhere close to you unless you make some effort and get educated and get this ball rolling yourself. And they sent us to Lifestyles Unlimited for the foundational training, and we opted and elected to go for the more advanced training there as well. And then thousands of deals later, I think I've had as many as 130, 140 units. Both single and multifamily myself. I think we're in the 80-ish range now, but it's a lot of fun. And my wife's parents getting this ball rolling really changed our family dynamic for generations.
That's great story.
Now what I'm really proud of today though is my work with Lifestyles Realty. In addition to my own investing, I can only do so many deals myself. And I sort of have a life mission in this area. I want as many people to experience this as possible, but I also think that what we do for the greater community is a super positive thing. That we go into areas and restore, in some cases, entire neighborhoods that have fallen apart, and we provide clean and functional homes for basically that working families can afford. and I'm very proud of that work. And with Lifestyles Realty, you know, since I've become the sales manager of the single family team there, I think we've had 6 realtors make the top 25 list at the Houston Business Journal 15 times. You know, including the #1 agent in the city currently. You know, last year we had 4 agents make the top 25 list. There are 40 something thousand realtors in the greater Houston area. And out of the top 25, not 25,000, not 2,500, not the top 250, but the top 25 in terms of transactions closed, we've had 4 of the top 25 last year. I think 3 the year before that. And, I mean, it's just, it's an amazing time. I work with a really, really talented group of real estate agents.
So your top guy was that the first time he was #1, first place in the whole city?
He was #1. It was not the first time.
Okay, I was going to ask. I couldn't remember if he ever won first place before.
He's the current #1 guy, and and 3 years ago he was the #1 guy, and on the alternating years he was the #2 guy. Yeah, so yeah, if you look us up, he's hard to miss.
Yeah, so we just came back as a company. We were over the weekend in Dallas. Lifestyles had their annual expo. It's a great place if you're a member or if you want to become a member to check it out. Tons of people there, tons of great information. Jeff, any highlights or things you want to speak about that maybe stand out from the expo last weekend?
Yeah, I think it was I haven't heard the debriefing yet, but it felt like the biggest one we've had. And it was already the biggest one in the country. So, you know, I think it just keeps getting bigger. I know that it keeps getting better. You know, last year, I believe my daughter was going through a lot of the courses, and you guys have a presentation that you do at our expo that's geared for beginner financing. You have another one that you do later on in the event that's more advanced. But I was taking my daughter through last year, which, happy birthday, Grace. Today's her birthday.
Happy birthday.
Yeah, and so we sat in on your introductory thing, and so she could get a really good grasp of what you know, how you fund these kinds of transactions. And you know, so I know your presentation, if you I'm sure you tweaked it over the last year, but I know that one is great, and I know mine, not to brag, but mine got it too.
We actually returned the favor and sent some of our new guys to your presentation, to believe it or not. Yeah,
Well, I hope they found it beneficial.
they did.
Well, I know that when I ran into Jeff Smith at the Lifestyles Unlimited LU Expo, and I saw him, I said, "You're that guy that's going to be on the Catalyst Funding webinar next week. I've seen you somewhere, you know." And so it was good to meet you. I'll offer the disclaimer for the webinar, and then let everybody know that, as always, one lucky listener will receive half off their next hard money processing fee. That's just basically a prize that we do every webinar. So I'll come back on at the end. We'll do a drawing for that. We also have a Q&A at the end. And so if you're listening to this webinar today and there's something as you hear our industry experts talking that comes to your mind, use the question function of this GoToWebinar and put that in, and we'll try to feature that at the end if there's time. And then also, I just want to offer this disclaimer that this presentation is really for your benefit and for general information only. If there's any documents or estimates that are presented here, they're not guaranteed to affect your investment or your portfolio performance. And so by viewing this today, we just wanted to let you know that nobody as a part of this presentation is going to be held responsible for any gains, any losses that you may incur, but we do want this information to benefit you. So with that being said, I'll turn it over to our industry experts, and I'll see everyone at the end.
Thanks, Derek. So, next slide, please. Yeah, I'm going to briefly cover this. We have so much content today. Most of you know what we do, but we are a short-term and long-term financing provider. We provide hard money to purchase and repair distressed real estate, as well as a wide variety of long-term financing. Our sweet spot is in that single-family 1 to 4 space and small multifamily space. We have 5-star customer service ratings across not only the LU platform, which we're very proud of, as well as Facebook and Google. So if you would like to speak to any of our loan officers, just please reach out. We can get you set up. But let's dive right into the presentation. So we're going to cover several slides early on here. Really what we're wanting to show is that a lot of independent third-party groups that are national media organizations are really talking up several of the major markets here in Texas. This particular slide, you can see this is Zillow's projection for the hottest real estate markets of 2023. And while we're going to cover several major markets, this one talks about Dallas in particular being number 4. It only follows a few markets, and Austin was the hottest market in 2021. We fell to 29 on this year's list, not entirely surprising because it was so overheated that it was just unsustainable long term, and they have had some pullback in value more than any of the other markets, but Dallas is still definitely very hot. Jeff, I know you're based in Houston, but interact a lot with the Dallas person who is at your comparable level there. I can't remember her name at the moment, but I know she's also another great leader. Did you get a chance to talk with her about Dallas and what she's seeing there while you were up at the meeting?
Yeah, we talk all the time, daily, and she's really on top of things there and really across the country. Matter of fact, one of these, I think this is my 4th time on your webinar. Maybe 3rd or 4th time, but one of these times you're thinking of me, you ought to replace me with her.
Okay.
That'd be a good presentation. But as far as Dallas goes, there's an interesting thing about Dallas. Dallas is the 4th most populous metro area in the country. Houston's the 4th largest city, but in terms of MSA, Houston's 5th, right? It's behind the Dallas market. And to me, the interesting thing about both markets, Houston and Dallas, is that if you look at the top 20 most populous MSAs in the country, as far as housing costs go, Houston is 2nd from the bottom, and Dallas is 4th from the bottom. Both of us are below the national average in housing costs. And I believe we're going to talk about migration across the country and toward Texas here. But imagine this: we're absorbing all of these new people, and we're well below average in terms of housing costs. How long do you think that is sustainable? You see where I'm going in terms of getting a hold of this real estate sooner rather than later. I think Dallas is 3.7% below the national average, and Houston is a whopping 17.9% below the national average. Both markets, I think it would be anyone listening to grab some of this stuff as quickly as possible.
We didn't have it on the slide, but I think Houston was number 1, and I'm pretty sure Dallas was number 2 in the country in permits, like new permits. So there's a ton of building going on as well. There's more here than anywhere else. May not be enough necessarily, but they're trying.
I think we do have that on the slide coming up.
Is it? Yeah, I thought we pulled it. All right.
But it's a great point. It's a very valid point. Good to meet you. Let's cover this next slide. Jeff alluded to this a moment ago. Migration trends. And as you can see, Texas is number 2 here. And this is not a recent phenomenon. This has been going on for about 10 years, just a steady movement from higher taxed, more expensive to live in states on the coast towards Texas. Florida is exceeding us a little bit at the moment, but Texas is definitely a very close number 2 there. And there's a multitude of reasons that both Jeff's and I and a lot of other real estate people in the state of Texas believe that there's really not a pending decrease in values. We hear that a lot from real estate investors say, I wait on the market to come down before I start to get in. We're going to talk about this a little bit later on, but I don't think that's going to happen. And you may be waiting a really long time for the market to correct, and you may just miss the boat as well. One of the big reasons is net migration. You know, we've already talked, it's incredibly affordable in the state. People are moving in, and there's just a shortage of homes, which Jeff's going to cover in one of his slides in a moment as well. We don't really see that dynamic of too much inventory and too few buyers that is necessary to have that price reduction. With this net migration only growing over time, it's hard to see that changing.
Yeah, the only thing off of this slide I picked up is if you look at like the top 10 states, 9 of the top 10 would be considered the South. You know, maybe I guess Oklahoma is pushing it, but other than Idaho, they're all in the South.
Yeah.
Next slide. So this is kind of more of the same. This is more so city. Talks about domestic net migration by metro. The areas experienced the largest influx were in Florida, Texas, Carolinas. Here's some of the markets: Ocala, Florida, Tallahassee, Charlotte, Houston, Deltona, and Myrtle Beach. You know, if you just kind of look at the map, it's like a heat map, right? The blue is where people are coming in, and the red is where people are leaving. And like I was just saying, you know, most of it is they're going from the north to the south. Like Wade said earlier, most of them are going from maybe higher taxed areas or not much in the way of economic opportunity to lower taxed, better economies. It's not much more complicated than that. Also, you got to factor in, you know, prices, particularly on the coasts. But it's just kind of more of the same that we've been seeing for the last couple of years. McAllen made the list. I see that down there at the bottom.
Yep.
You do any deals in the valley or anybody?
We do. Matter of fact, we have an agent who's dedicated to that area. So, you know, she's going to work with Lifestyles and Unlimited members with investment properties before anybody else in that area. But, you know, Ana Ortiz is our point person down there in the valley.
Cheap down there, really cheap properties.
Oh yeah, yeah. Now, one thing I'd point out here on that map, and you don't have to go back to it. It's just the blue areas generally match what's coming up on this next slide, and also match the previous. You can move to the next one. It's fine. You know, your pins on this one match the blue areas on the last one, and they generally match that Zillow map you had up there three slides ago. If you were to superimpose these maps, the maps don't change all that much. And you know, if you also then add another layer of the Lifestyles Realty offices, the ones that we already have and are planning to add this year, there's a really, really close match there.
Yeah. I was gonna ask you that because I was like, wait, I was looking at the cities and the states, like that's exactly where you guys are. You talk to people in all those little spots right there.
You know, oddly enough, I thought that the lady you talked about earlier, her name is Lee Bell, with our company. She's the vice president of realty operations at Lifestyles, and she told us 2 months ago where we were headed this year in terms of new places. And then 2 days later, the map you're looking at right now pops up on the National Association of Realtors website. I thought, wait a minute, do you have like information that I don't have? And no, she just accurately predicted what where we should go.
Yeah. 2 quick points, and then we'll move on to the next slide here. One, Dallas on the list again. Number 3, this is a separate news media organization. Actually, this is the National Association of Realtors. I'm sorry, as Jeff already mentioned. One interesting thing on number 9, we pulled this excerpt out, and it's one of the reasons that so many single-family investors are excited about San Antonio, another great market. is that the median priced home here is about 85,000 compared to 130. I'm sorry, median qualifying income, my apology, 85,000 versus 130,000 in Austin. And a lot of the people can commute to some of those jobs in the greater Austin area, these tech jobs that are moving in. So that's one of the big reasons that we consider San Antonio a great area for single family 1 to 4 investors. But another big reason is just the similarities to Houston in the fact that home prices are reasonable, but rents are high. That's something that you don't have in Austin, and it's a little bit more challenging in Dallas too, because the home prices are higher. I think we're seeing some of the markets just outside of the major parts of Dallas are where the single family investors are really doing well. We see quite a few deals outside of central Dallas and the major suburbs. But San Antonio and Houston, conversely, great deals throughout the city.
Oh yeah, our San Antonio team is the fastest growing part of our company. Last year, I think that our Atlanta team is poised to grow even faster this year. But San Antonio, I mean, it's the 7th largest city in the country. I didn't realize that, until I was talking about MSA, that I was talking about MSAs in a company meeting a few weeks ago, and somebody asked about San Antonio, and well, where is San Antonio on this list? And that's at that point we realized, while their MSA isn't in the top 20, the city is the 7th largest city in the country, and there's a lot of opportunity. And the cost, the housing costs there are very, very friendly to real estate investors.
We'll deep dive some of the data there, but the ratio of rents to home prices are incredibly attractive. Next slide.
So this is the Texas housing supply days on market. We just kind of wanted to show this and give it a little perspective. So homes are sitting on the market longer. Right? Texas's average days on market was 52. However, if you compare that to the 5-year average before 2020, so before the pandemic, the 5-year average was 59 days on market. So the point of this is that things are getting back to a normalized, or back to the mean, basically, on the days on market. We had some crazy times the last couple of years, but while it may feel like things are slowing, they're just kind of getting back to normal. I thought this was a crazy stat. Austin's days on market rose from 19 days to 67 days. So that is obviously quite a leap. But the point of this is that these numbers that you're seeing now on the days on market is kind of going back to the pre-pandemic averages.
Yeah. Don't get caught up in a recency bias. There are a lot of areas you can do that in, right? The market during the past year and a half, 2 years was the absolute hottest in history. Like, you cannot compare to that and say the market is slowing or I need to be nervous about real estate whenever you're comparing to something that was that unusual. To Jeff's point, if you go back to pre-pandemic, we still don't have as long of a days on market, even though there are a lot of people saying we're kind of in a very slow market. And 6 months is really balanced, and we're not anywhere close to that for sure. The next couple of slides are actually taken from Jeff's presentation that our loan officers were raving about whenever they were able to visit it the other day. So Jeff, why don't you walk us through each of these slides? Maybe Jeff and I can opine if there's something else we have to say about it.
Of course. So yeah, there are, at lifestylesrealtyinc.com, I'll occasionally post some of these, anytime there's something interesting there to talk about. And one of the more recent posts I've had is I get the question, wait, rates are up, sales are down, shouldn't prices be dropping? And that's what you were just talking about. 6.5 months of inventory in Texas is considered to be a balanced market. Below that, you're in a seller's market. Above that, that's when you get to be a buyer's market. And you don't normally expect a downward pricing shift unless you're in a buyer's market, right? And unless you get north of 6 or 7 months of inventory, if that's still accurate, that's the balanced market. We're at 2.7, I think, here in Houston in the last HAR report.
Yep.
In the last market cycle, it took, we started in 2008 when things turned downward. We started in the 5s, right? The month of inventory was like 5.5 or something like that. We didn't get past that 6.5 to 7 month range for 2 years. It took 2 years, and that was a time when we had a lot of sellers who were credit crunched, right? That cycle drop was based on poor credit decisions in both the borrowers and lenders' cases, frankly. And there was a lot of distress in that market within the existing homeowner community. That doesn't really exist today. That now I will say this, that's in the single family existing home community. In the multifamily world, there is credit distress, right? People got into short-term loans on value add properties, and now they're coming up and having to deal with refinancing those loans in a more stressful credit environment. And so in the multifamily world, so when you when you hear people in our business, even in my world at Lifestyles, right? You might think you're hearing conflicting information, things that contradict each other. I don't think you really are, because in the world of existing homeowners in the last 15 years you guys on the lending side have scrutinized them more than, the number of subprime loans or non-conforming loans in existence today is a fraction of what it was leading into the last cycle. In the multifamily world, it's less so, but there's still, and that's what people are worrying about. The other thing is that in our world, in just the general real estate community, right, people who are transactionally based employees, people like in most brokerages and in most lending groups, that don't really have as large of an investor clientele as we do, they can be struggling too, because the transaction numbers are down. Prices aren't down, the transaction numbers are. And these businesses that are transactionally based, like normal brokerages, traditional lenders, title companies, appraisal companies, they are stressed, right? You're hearing the sky is falling from them, because for them it is, but that doesn't mean prices are falling. And we talked about it in the last slide, right? For prices to fall, you have to get above that inventory level, and we're a far cry from that right now. There are a lot of reasons for it, but I think you guys asked about one of my other blog entries that addresses that. So if we don't, remind me, and I'll get to all of those reasons.
Yeah, I think we can cover that on the next slide. I did want to add one point for the people listening to the call and who will listen to it in the future. That the way that appraisals work on single family investment loans is one of the things that provides real stability in this current market. Home prices are not dropping, right? Interest rates have increased, but the interest rate increase does not drive a drop in the appraised values like it does in commercial multifamily. Commercial multifamily appraisals are built on a net operating income evaluation, and that really gets crushed whenever interest rates double, right? So that's one of the problems that Jeff's talking about, is if you went into a multifamily deal expecting a 4% rate, you're gonna have a certain net operating income. Now it's gonna produce a $10 million appraisal. You're gonna be able to borrow maybe 7.5 million. You're not seeing that dynamic in the single family space, where you might be able to borrow 20% less and still have the same cash flow, right? That's a real challenge in the multifamily and commercial space that we aren't seeing, because traditional home buyers and sellers, there's not a lot of transactions taking place, but home prices are not dropping because sellers are staying in their property. They're happy at that 4% rate. They may not be selling at the moment, but they're also not selling at a discount, which is why that market is very stabilized.
You know, there are two things there though, right? In either case, there's considerable opportunity, right?
Mm-hmm.
No matter what, no matter which case you're looking at, there's considerable opportunity. Now, in the case of in the single family world that we're speaking of mostly here, I wonder, the three of us sitting here in the Houston area, right? We have a real stability bias, right? If someone's watching this from, say, Las Vegas or one of these other more volatile markets, you know, their heads might be exploding right now if they're, you know, listening to us talk about prices are stable. We're seeing normal appreciation, and in those more volatile markets, it's just I wonder what their perspective is, if it's different than ours.
100% it is. I did see an interesting stat before we move on to the next slide. San Francisco is back down to its pre-pandemic values, which I think it's down 35% from the peak. That's a crazy number, right? So you're absolutely right. And don't quote me on that specifically, but I'm pretty sure it was around 35%. Went up 35% during COVID, back down to where it was pre-COVID. So that's an amazing stat. So we're on slide, next slide here. This is yours as well, Jeff.
Okay.
Nope, maybe next slide. I'm sorry, that one.
That's it.
All right. This is interesting. So the Houston Association of Realtors produces a rental market update that I find very useful. And they produce it every month. It's just all on their website every month. I think it comes out middle of the month, second or third Wednesday or something like that. Now there's an important part of it though, an important piece of information in the rental world that hasn't been covered in this report, and I think it's important in our world, because think about who our customers are. The people occupying the properties we buy for investment purposes. These are working class people, right? We're not leasing to executives. And our clients at Lifestyles Realty, we're not doing short-term rentals, Airbnb type properties. We're doing primary residence, primary rental residences. And so if you look at what the median household income is in Harris County at around 60 grand, that's a $5,000 a month income. Well, that family can afford a $1,500 a month rent. And while the number of rent properties that are available is going up, the number of rent properties that working class families can afford is a smaller portion of the market. There are fewer choices for them. And for our clients at Lifestyles Realty who are buying these properties, they're just not or should not be experiencing any kind of significant vacancy at all. I mean, when we put a property out there for lease, we have 30 calls. I mean, these things are moving fast, and it's really a shortage at that pricing segment.
Absolutely. So we have one more slide from Jeff. Let's cover this one. This is another blog that you recently put out.
You got it. So this is the one I was talking about, where you think about the path. We mentioned builders earlier, and builders aren't necessarily the solution, because they can't build at a price point that we're buying for investment properties. You have land prices going up, you have labor prices going up, materials prices going up, the cost of regulation is rising. They can't build starter homes very easily, and they certainly have a tough time doing it close to any metro area. So you've got to go further out and get smaller lots to find the kind of new builds that would work for starter homes or for investors. So you don't have new inventory coming from them. So what about existing owners? Well, you would need existing owners who aren't also buyers to add to the inventory level to get that pricing shift downward to occur. And so that means you have distressed, the credit kind of problems that we were talking about earlier. And, so you would need for them to like lose their jobs, go through their savings, use up their credit, use up their home equity, default on their mortgage, not go into some kind of a forbearance arrangement with their lender or default on it before they ever become distressed. Well, there are 11 million jobs available right now. Unemployment level is the lowest it's been since the 1960s. There's $1 trillion in savings, in accumulated savings with U.S. households. Homeowners' equity is as high as it's ever been. Right, the only one of those that's moving in the wrong direction is credit card debt. Right, that is rising, but all of the rest aren't moving in the wrong direction. So, where is this distress going to come from? And I don't know. I know where it's coming from in the multifamily market. It's coming from people who got into who got short-term financing on large value plays. It'd be like somebody borrowing in single family hard money and then having the market turn on them before they complete their renovation and do a refinance. But in the single family world, there just isn't enough of that kind of thing to affect anything. And even if somebody got into that situation, you'd figure out a plan for them before you took their property away.
100%, yeah, for sure. Yeah, we've been saying that for some time. We definitely agree with you, and we're going to go over that in the next few slides. We don't see the prices dropping anytime soon, but that does not mean that there are not excellent deals at the moment. The home prices do not have to drop for there to be excellent deals. So we're definitely going to cover that.
Matter of fact, deals have gotten better as interest rates have gone up, which is counterintuitive. But here's the other part of that same equation, and that's in that article I linked to a couple of other places that point out that there are big institutional buyers that are building up these giant war chests to get started or to get restarted in the single family world. There's a company called Tricon that has $3 billion ready to deploy. JP Morgan has $1 billion ready to deploy as soon as they feel like rates are stable. Well, once that happens, regular people are going to be back in the market too.
You're missing the point.
Yeah. So right now, get in now before all of those other people do.
100%. Let's go to the next slide. We're going to cover this very briefly. It kind of tags on to what Jeff's been talking about. Rental vacancies are incredibly low right now. He was talking about how you have so many different people out there looking to get into these rental properties, especially in the warmer markets like we have across the state. So vacancies very low across the board. And it's interesting that the vacancies match up whenever rates and inflation are higher, right? Because it is a little bit more difficult to get a home. So landlords, this is a really good time to be a landlord because of those dynamics, for sure. So let's go to the next slide. And this is something that Jeff and I actually covered at our recent event. We were looking at our internal lending portfolio and what percentages of the after repairs value people were paying before interest rates went up. On average, that was about 90% of the deals that we lent, below 300,000, kind of that sweet spot for buy and hold investors, 90%. So $300,000 home, $270,000 less repairs. Let's say repairs are 10,000. They're paying 260, right? Conversely, whenever rates went up, that dropped to 72.5% on average. So that same deal, they're paying about 215, take out the repairs, 205. That's a massive amount of equity capture difference from whenever rates were higher, whenever rates are higher now, when they were lower before. So we thought that might just be something that's like a Houston-based number, Texas-based number where we primarily lend. But I was recently listening to a podcast, and auction.com had national data that very closely aligned with what we were saying. The prior to rate increases nationally, their discounts were about 9%, and now it's about 29%. So those numbers really align across the nation. So whenever people tell us that they are waiting on the market to turn to get good deals, one, I think we're all in agreement, we don't see that happening. But two, the time to get really good deals is now, because you're getting enormous equity capture. And you still have the ability to refinance that rate down the road. If we go to this next slide, if that's okay. If we can go to the next slide, please. Thank you. This is an example whenever people were at 90%, right? This is the average deal before rates went up. You can see, I'm just going to cover a couple quick things. Out of pocket at the bottom, you know, 55,000 on that size home. Now, admittedly, the average out of pocket from someone like LU, because the average home was not a $300,000 home, was less. But we were seeing a lot of 35s and 40K out of pockets. You know, that was not uncommon. Conversely, we go to the next slide, and on that same home, we're seeing these deals routinely, 3,000 out of pocket. In fact, one of our top loan officers, Jessica Sauceda, had 3 deals that were at this number or under in a row directly from LU agents recently. Now, we don't want to make you think that every deal that's not 3,000 is a bad deal, because these may be in some more, you know, outside of major metros, maybe more transitional areas. You got to weigh all that in. But the bottom line is, this is an excellent deal versus a deal where you were far more out of pocket before. And then I'm moving through this a little bit quickly, but I'm trying to hit the highlights. If we go to the next slide, on this 90% example, you see the key point I want to make here, 2 numbers at the bottom, 754 cash flow, equity capture 14.7. Big cash flow on a home of that size because the rates were so low, but very limited equity capture. We go to the next slide, please. You can see the 72.5% example, which is where the market is now. That same home, 62.1 in equity capture. But here's the best thing about it: go down a little bit, refinance at 4.25. The cash flow is the same, right? Because the loan amount's the same. The difference is your ROI is exponentially higher because you're out of pocket so much less. Now, there's no guarantee that rates are going to get to 4.25, and there's no guarantee on the time frame. My guess is it's going to happen in the not too distant future, maybe a couple years out, maybe 2, 3, who knows? But you can weather the storm for a while with that equity capture that's guaranteed. You can never change the purchase price. You will eventually be able to change the rate, and that's the market we're in today. Anything to add to that, Jeff or Jeff?
Well, this is consistent with what we're seeing in our transactions, although, like you mentioned, you know, that starting number for us is lower because, you know, we look at what the median household income is and find what that family can afford, right? And so that puts us generally about $100,000 less. So if you look at this slide and you just knock everything by a third, it's very consistent with a typical transaction with our group at Lifestyles Realty.
Yeah. So instead of 750 cash flow, before it was maybe 500, and now it's dropped some. Equity capture instead of 62 at maybe 40, something like that, right?
That's almost exactly the number.
The only thing I would mention is, you know, if that low cash flow number scares people off, well, think about it. Like, forget the fact that you can refinance, which Wade is right. You'll eventually be able to refinance. Who knows what the rate will be, but they'll go down at some point. But also every year, every couple of years, when you renew your lease, you can raise the rents too. That's the other thing. So like your payments staying the same. Your taxes might go up a little bit and your insurance might go up a little bit, but it's not going to go up at the rate with which you can increase your rents in almost every circumstance. So it's never going to get any worse than it is right now. It's only going to get better as far as your cash flow goes, either raising the rent or refinancing.
Well, let's see, Jeff, that's the sales pitch for buying in inflationary times, right? Your highest expense is interest expense, and you're fixing that while everything else is going up, including your ability to change the pricing structure of your product.
Right.
And
It
so
makes
you're
sense because you're getting so much cheaper properties. Next slide.
We're actually going to skip this one. We've covered this recap pretty thoroughly, and we'll move right into a slide that Jeff's going to cover. That's okay.
Yeah. So this is something we talk to people about a lot. Buying properties, even though it is cheaper, eventually people run out of cash, or some people do, right? So they're forced with the decision. Okay, I have maybe a property that isn't maybe it's my mortgage, the house that I live in. Maybe it's a rental, but most likely it's a house that you live in and you have a great low rate because you bought or refinanced during the good times. But you have a lot of, and values have gone up quite a bit. So you have a lot of equity in that property at a really low interest rate, but maybe you don't have much cash and you want to get into real estate investing. Like I said earlier, when you first started, didn't have much money to start, but you knew you wanted to get into it. So we've done some examples, and I'm not going to go over every single one, but I'll hit the final results. Basically, the point is, if you bite the bullet and forego that low interest rate that you have on your mortgage, you pull out enough cash to do deals by purchasing those properties over a relatively short time frame and a relatively safe appreciation assumption. You'll see how it increases your net worth significantly more than if you just did nothing, right? So if you go to the next slide, please. So basically, these numbers are small, but like I said, I'll just hit the highlights. You're looking at an example of somebody who's got a $400,000 house. They owe $200,000. They have a 4.5% rate. So they pull out some cash. They do a home equity or refinance. They go up to 80%, and they're able to pull out roughly a little over $100,000. So in that transaction, and your payment, let's just say your rate goes to 6.5. So your rate goes up 2 points, and your payment's going to go up $500 a month. However, with that $100,000, in this example, that's going to buy you 4 properties. Now, depending on where you're finding deals, it may be a little bit more, maybe a little bit less. But in this example, you're going to take that $100,000, buy 4 properties, and we're going to start with a very modest $250 cash flow per property. And over time, and 250 ARV. So these are regular deals you would buy in Houston or Dallas, Texas market. Over time, we did a 10-year horizon at 4%. I'm sorry, 4.3%. So you're going to have a higher payment, $500, but you're going to have 4 properties, cash flowing 250. So you're going to come out ahead a little bit monthly, but every month, like I said, or every year, it's going to get a little bit better because you can raise that rent. So we basically have 2 numbers we look at. What is your net worth from this situation if you do nothing? If you just say, I'm just going to pay off my mortgage, and 10 years from now, where am I going to be? So what is your net worth in that scenario versus 2, I'm going to refinance, pull cash out, buy 4 properties, and 10 years down the road, what's my net worth going to be in that scenario? So if you go to the next slide, please. Like I said, there's a lot of summary notes on here, but the main numbers are the ones in red and green. So you're assuming a 4.3 appreciation. 10 years down the road from right now, if this is your situation, you'd have a net worth of about 475. That's pretty good, right? You've gone from roughly 200 to 475. However, if you take the leap, pull the cash out, buy those properties, that's going to get you 10 years down the road to a net worth of roughly $1.4 million. And the difference obviously is almost $1 million in net worth increase. Just the power of compounding and getting in, like Jeff said, you're getting that equity capture right away. So you have a certain amount of equity, and every year you're paying a little bit more on your mortgage. Every year your property values are going up 4%. by taking that money and deploying that debt equity you have in your house and using it to buy more properties, it's pretty powerful how much more money you can be worth at the end of 10 years. God forbid you go to 15 or 20, these numbers just get ridiculously different between the two scenarios.
And if I'd add one thing, and I'm sure Jeff's thinking the same thing, and I'll let him talk about it, but the Lifestyles model and model we encourage is not to wait the full 10 years. We're just using that as an example. Really at the 5-year point, you're either going to sell those properties or refinance them. And then this becomes even larger because you'd probably be able, with the appreciation, to buy 4 more homes at the 5-year point, maybe even 5 or 6, maybe put into some passive multifamily investments. So many different things you can do there, and these numbers just start to grow. When we hear people talk about that, sometimes they come up to us at a Lifestyles booth, or we meet them at another industry event, or they're on a phone call calling in. They're like, I only have 25,000. You said, well, do you have any equity in your home? Yes, I do, but I've got a 3% rate. Like, hey, that sounds great, and that's the easy thing to talk about at cocktail parties. I've got a 3% rate, but that debt equity does you nothing. Dale Walmsley, the founder of Lifestyles, talks about this all the time. It sounds great to have that equity, but what's it really doing for you? It's really doing nothing. Using that equity to reinvest into something that's going to be a cash flowing asset is so powerful. This is like the most conservative estimate we could do, and the numbers are still fantastic. It's not reinvesting at the 5-year point. It's not taking it out to 30 years. Like, there's so many more numbers. If these numbers, if we went out to 30 years, reinvested every 5, the numbers aren't even comparable. I mean, we're talking about tens of millions of dollars of extra equity over time. Jeff?
Well, yeah, now I will say this, that if you follow that route that you just talked about, Wade, where you are reinvesting over time, you're going to get to a point where you graduate to multifamily properties well before that 10-year mark. And at that point, you're in much greater control of everything, of the property value, of your time, of your lifestyle, right? That's why we do this, is for freedom, right? And when you get to that level and you're hiring, managers to run your properties and that kind of thing, you get there much quicker. Another thing I'll point out is on the upper right corner of this worksheet shows a property appreciation rate of 4.3%. If you go to the Texas A&M Real Estate Center's website and look and map that out for Houston, it's 4.8%. And so if you were to make that one adjustment, that green number at the bottom is going to be a 7-figure number instead of a 6-figure number. And the salesman in me really wants that to be a 7-figure number.
Yeah. We tried to make this as conservative as possible because honestly, the numbers are so compelling whenever we go over them with some of our potential borrowers that they always say, well, is this conservative? So we shaved almost everything back, and the numbers are still really compelling. So, but it would be nice to have a 7-figure number there. It'd be a little more powerful for sure. All right. Great job on that, Jeff. So customers also often ask about this. We think interest is just a function of your overall investment goals, but people ask about it, so we're going to talk about it. The prognosticators range anywhere for 2023. If you look at the top one, 5%, next 5.2. As you progress down, we kind of did this in an order. Some this one Realtor.com analyst is saying 6 to 7% by the end of the year. So for some people that are saying they're trying to wait until rates get better, there's so many different predictions. I think you want to look at the quality of the deal, know that rates will eventually get better. And if you can get that equity capture in an area where you can cash flow and you really believe in the deal, that's a lot more relevant than trying to time the market is the bottom line here, because the predictions are all over the board.
If you think the Fed is doing a good job and they're not overshooting, right, that they're gonna get inflation tamed without sending us into a recession, then the interest rates at this level where we are now, it's reasonable to assume that they stay. If you think that they're overshooting the mark here and they're going to send us into a recession, how do they fight inflation? How do they fight recession? Right? The opposite of the way they fight inflation, and that's by lowering rates. So if you know, there's another reason to buy now, right? Get today's prices, but if they send us into a recession, they're going to fight it by lowering rates. But if they don't send us into a recession, the properties just continue to, the values just continue to grow, right? So either way, as a buy and hold investor, you win, no matter the market.
Yep. The next slide is just historical inflation rates. I mean, we cover this regularly, but while rates feel high right now, don't get caught up in that recency bias. I mean, before, you know, the great financial crisis, the Great Recession, whatever you want to call it, back in 2006, 7, rates were really never this low, other than maybe a blip on the radar. So still historically very low, just a lot of very, very low rates over the past, 15 years or so. We have a little bit of time now. We've got about 4 minutes. The housing start slide, I'm just going to cover very quickly. The only reason we cover this is another very telling reason why we don't see a huge reduction in home prices. If you look, they were building more homes than we built for the past decade in the 50s, 60s, 70s, 80s, and 90s. So that's a very telling number. There's just not enough inventory out there. And, Jeff covered that earlier. You got to have an oversupply for home prices to drop, and we just haven't built enough for that to really happen. Next slide. This is where I wanted to get. Jeff, you look at this all the time. You're based here in Houston. Jeff Smith, go through this slide for us and tell us what you're seeing here.
Well, it's more of what we talked about before, right? In that transaction numbers are down. Because transactions are down, total dollars in our business is down. And so that's why you hear people talking about real estate being in a recession, because of that decrease in volume. But it's not prices that are down. Look at the whichever one you want, the average or the median sales price movement. It's up considerably in both cases. And what I usually tell people is this: if you really only have enough bandwidth to follow one metric in real estate, follow months of inventory. Months of inventory takes elements of supply and elements of demand, meshes it all together into one simple number. And if that number gets to 6, then things will start to change. If it doesn't get to 6, I wouldn't expect much movement. I wouldn't expect much change directionally at all. If you have a little more time, then look at the rest, because for really, really analytical people, it's fun, right? But outside of that, just watch that one number, months of inventory.
Yeah, the only thing I'll say is these are 2021 prices compared to 23, but to the slide earlier, the median price in 21 was 263, and 22 it's basically 310. So even with that COVID year in there at 315, we're still year over year above on the prices, to Jeff's point earlier.
We kind of reconformed this slide a little bit and didn't give Jeff Smith as much advance warning on that one, so apologize for that. We're really up against it, and we did talk a lot about Dallas already. Austin, not a huge buy and hold market, but Jeff, are there any key points you want to take out of San Antonio before we wrap up?
Yeah,
Jeff?
I think in San Antonio, you have a better pricing. San Antonio being the 7th largest city in the country, even though rent increases haven't happened as fast as they've happened here, with the migration towards Texas, I think they're coming. I think San Antonio, that whole Central Texas area outside of Austin, is offers strong opportunity for buy and hold investors.
Jeff Johnson, anything on San Antonio in particular before we move on to the affordability index?
No, it's very similar to Houston in that respect. I think everything's very close. The numbers are almost identical.
Yeah. So on the affordability index, I did want to make a couple of points. This is a comparison of January 2023 to January 2022, which is really interesting because back in 2022, and this is really a lack of affordability index. That's not what it's called. But if you're ranked higher, there is less affordability. So if you on the right, we have 2022, and a lot of the Texas markets were creeping up here. 21 Austin, 22 Dallas, 29 Houston, San Antonio still pretty affordable at 51. But it's very interesting how Austin has become more affordable comparatively, down to 24. Dallas down to 34 from 22, and Houston all the way down from 29 down to 43. So as the rest of the country is becoming even less affordable, Texas is becoming more affordable despite people moving to the state with regularity. So I do believe there's a couple of different reasons for this, but the simple fact is that we are able to build more properties. Jeff talked about this earlier. We have more permits to build in Houston than any other city in the country. Dallas is second. A lot of these other states that are, more expensive, they also have real problems with being able to get permits to build more homes. And it's just a real problem in some of those areas that we don't have as much of a problem here. But I find this to be a real positive for net migration continuing to stay strong, and lots of opportunities to have quality renters, because people are going to keep moving here because the area is more affordable without that question.
Any last comments, Jeff, before we wrap up?
Well, you mentioned nationally, but you mentioned affordability and the constraints builders have. On the national average for what builders spend on regulation alone is $94,000 for each single family home. That's what they spend in regulatory expenses, right? How can you spend $94,000, then overpay for lots, land, and labor, and build something that working families can afford? Like I mentioned earlier, it's very, very difficult to do. And the kind of properties that we own and that we're buying and that our members are buying, our clients are buying, it's very difficult to replenish that inventory. I would encourage anyone interested in doing this, sooner is better than later, and get as much of it as you responsibly can.
Yeah, I completely agree with that. Now is definitely the time. So if we'll go to the next slide, if you want to reach out to Jeff Smith or anyone at Lifestyles Unlimited, this is Jeff's office information, but they also have other 1-800 numbers that you can reach out to. Fantastic organization that will guide you through the path to successful real estate investment. We really believe in their platform, so please reach out to them if you are looking for that mentorship to help you change your financial future. Really appreciate everybody hopping on the call today. Jeff, thanks again for being an excellent guest, and happy investing out there. Everyone have a great one.
Thanks, Jeff.